From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the 1st of November 2024. Let's check the calendar. Well, the Packers kick off Sunday against one of the better teams in the NFL, the Detroit Lions, and your struggling Milwaukee Bucks are in Memphis tonight and back home Saturday night with the Cavaliers. The most important day of the upcoming week, of course, is Tuesday, Election Day. It's also the day when the incessant political TV commercials and junk mail stops. I hope. This program is called Money Talk, so I suppose I should talk about money once in a while. A Russian court has ruled that Google owes its media stations around $20 billion in fines for blocking content. To put that into perspective, the World Bank estimates global GDP at around $100 trillion. Google would therefore have to come up with more money than exists on planet Earth. And if you must know, a decillion is the number 1, followed by 33 zeros. The North Carolina man hit the jackpot twice, first when he found $20 on the ground outside a convenience store, and then he immediately reinvested it in a $25 lottery scratch-off. That ticket paid him an instant $1 million. Who says lightning doesn't strike twice? And our headline of the week, woman arrested for shooting husband while he slept after he caught her cheating. My wife thought he should have minded his own business. On the podcast today, we have Adam Baley, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A bit of a tough week this week, despite what's been an overall good year. In recent stretch, the NASDAQ down 1.5% this week, down 279 points to close at 18,240. The S&P 500 down 1.4%. That's 79 points this week. And the Dow Jones Industrial Average almost able to pull it out, but down 63 points on the week, 0.1%, closing at the bell on Friday at 42,052 for the year. NASDAQ still up 22.2%, the S&P up 21.5%, and the Dow Jones Industrial Average up 13.3%, including dividends. Bit of a bump higher in Treasury yields this week, the 10-year moving from 4.23 up to 4.36. Bond investors may be seeing a little give back along with the stocks this week. You know, Adam, maybe the place to start is Thursday, the first 1% move we've seen since the day after the Fed announcement in September. Despite what certainly has felt like a volatile stretch from a news cycle and headed into an election week, markets themselves have been fairly calm. And so what are investors supposed to do as we head into election week, another Fed announcement, if we see some volatility come back?
Well, investors should do nothing besides have patience with all of that. But no, I think you're absolutely right. It's been a volatile news cycle, but it hasn't been all that volatile in the market. That the Halloween decline, I guess I kind of greeted that initially like, oh, finally, we got a big enough move because it's been sanguine, it's been quiet. A little bit unusual, I guess, for October. October has historically been one of those more volatile months. But you look back over, not just this past year, but the past 2 years. Go back to 2022. I mean, the market is up substantially in the past 2 years. We're up about 60%, give or take, from 2 years ago, up a lot this year. At some point, you sprint this far, this fast, you have to have some occasional givebacks. You have to have a time to pause and to catch your breath. And that's what we saw with the 1% move back.
I joke with clients that maybe the right thing to do the end of November here is just not look at your statement and move on to the end of the year. Look at, where we started the year, where we hopefully can finish the year, and kind of maybe try to strip out some of the volatility that is going to be likely the last couple of months of the year. There was an article in Market Watch this week that talked about kind of this expectation that volatility might pick up a little bit based on what we're seeing in the VIX, which is just the volatility indicator. What do investors think is going to happen? And of course, they expect some more volatility as we walk through the end of the year. And yet I think, John, maybe perhaps sometimes we forget that volatility isn't always a bad thing. Volatility speaks to magnitude, but perhaps maybe not direction.
Yeah, and you were talking about this earlier, is volatility is just movement. and frequent movement, maybe unexpected movement. It doesn't necessarily mean movement downwards. And one thing that we did talk about is even in election years when the markets are up substantially January through October, typically we see a November and December strong finish. Granted, it could be volatile, and we expect it to be pretty volatile. Volatility, like I said, doesn't mean downward. I guess investors and clients especially kind of frame volatility as a negative thing because they notice when the volatility results in downward movements.
The volatility reminds them that they've got stocks and
exactly
and that they go up and down. Yeah.
Volatility is one of those things as an investor, it should not be feared. You should just know that volatility is normal. It's expected. It's okay. I don't like it more than anybody else. I don't. But you have to remember that volatility has a purpose. The reason why you get paid so handsomely to own stocks is to put up through all of the volatility. So when we get those big up days, big down days, remember it's the reason why you get paid the way you do to own stocks.
Well, and I think when we talk about applying the concept of heightened volatility to how we manage portfolios, there isn't a day that goes by that I'm not looking at portfolios and going, all right, have I set aside enough, right? Are my clients that are invested this way going to be taken care of? And it's why when we talk to our clients, one of the first things I'm asking is, hey, what's new? What's going on? Because what I'm getting at is not, hey, tell me all these wonderful things. That's what I want to hear, but also, how's life changed, right? What are you up to? What might that mean for spending? And how can I maybe account for some of that? And so I think it's so critical that we have the conversation about need, because in a year or two, Adam, as you pointed out, in which gains are as strong as they are, well, that's just opportunity to meet the need that we know is out there, and it's why that conversation is so important. I was struck, John, by an article in the Wall Street Journal talking about how big tech is finally seeing some of the maybe payback for the early adoption of artificial intelligence. In a previous career for you spent time building out or helping build out kind of warehouses for what was a trend towards the replacement of kind of brick and mortar. I think we're seeing now this kind of new phase of development, sometimes the same businesses that were part of that story, but it's created this massive opportunity. Businesses like Microsoft that are contracting to restart nuclear power plants and to have these massive kind of solar developments. I wonder what kind of lessons there are out there for investors as we see, this kind of massive demand for this technology and maybe what it means for us going forward.
Yeah, and I mean, if you look at that particular article, kind of outlays that this last quarter, Amazon and Microsoft combined had $63 billion in revenue attributed to their cloud computing AI business. And like you said, I did work for Amazon a while back, and in those years, you could really see how they forecasted out how strong the demand for their delivery services were going to be. And that resulted in a mad scramble to build as much infrastructure as possible to try and handle as much of this demand as possible moving forward. It seemed like every single year that I was there, it was double warehouses, triple warehouses across the country. And now you're starting to see these large tech firms doing the same thing, but for AI-related business. And these guys are pretty good at forecasting what they foresee is going to be a profit maker in the future. And if they're scrambling like this for AI infrastructure, that they're onto something.
If we're building not just like new assembly plants or warehouses or, cloud computing center, what we're talking about on an economic level is something called capital expenditures. And it's a big deal because businesses over the past, I want to say 10, 15 years have been at times stingy with their cash and their earnings, and they have hoarded it, and they haven't done much with it. Sometimes they've done some buybacks and other things, but they haven't invested as much historically in capital expenditures. And the reason why this is a big deal is because 20% of our economy, comes from business spending. 60 to 70% of it comes from consumer spending. That's us. But in the next 20 is business spending. And we haven't had much capital expenditures from businesses in the past, but now building AI warehouses or data centers or assembly plants, that can have a big long-term impact on economic momentum going forward.
I think you paint such a clear picture of the opportunity there. As a business, you have really three choices with your cash. You can pay dividends, you can buy back your shares, or you reinvest in yourself. Mm-hmm. And that's what that capital expenditure is. And it doesn't just drive returns today. A dividend given back to the shareholders is a nice little boost, but it doesn't help you grow your earnings tomorrow. Likewise, buying back shares maybe makes the current earnings look a little more attractive because there's fewer shares out there, but it doesn't help you grow those earnings going forward. And the benefit that capital expenditure has that those other two uses of capital don't is that it builds on itself. If you spend another $1 billion, well, okay, the hope is you can earn an extra $1 billion next year. And that's another $1 billion that you can spend in one of those three ways going forward.
And there's also the risk of that failing, that they're making the wrong bets, that they're investing wrong. But that gets back to what Adam was saying before about that's why you get paid to invest in stocks.
Yeah, and you touched on something, Kyle. I'm going to take it on a little bit of a tangent, something called the money multiplier effect. And this is more true to like the banking industry, but this applies to capital expenditures for business. But we know that when, whether it's either businesses or banks put money into the economy, they build a new assembly plant, that money can get turned over maybe 4 times or more. Like if you're going to build a new data center, you have to hire the construction workers to do it. The construction worker goes out and buys a new truck so he can get to the job site. The truck salesman takes his family on vacation, and the hotel they stay at gives their staff a raise. And it's stuff like that that can expand out into economic momentum in a bigger picture than just the businesses doing a cloud center.
Yeah, I think velocity is so important to the economy and having money move through the system, and that doesn't happen if you just give it back to the shareholder and have it sit. It absolutely happens if you're giving it to the people doing the work. I think that's such an important point. Joel, on the economic front, we had quite a bit this week, and I think some pretty important numbers, not the least of which, maybe looking at jobs data from October, a whole bunch of noise there, a lot of kind of structural issues potentially in how we measured in October, but some, I think, important trends that kind of have continued to develop.
Yeah, Kyle, so the October jobs numbers, the noisy part of it was that we had 2 hurricanes and tens of thousands of striking workers in October. So when you put those together, it can create some confusion in all the numbers. The net result was that the unemployment rate stayed the same at 4.1%, same as September. And the number as far as jobs added to the economy or taken away from the economy, employers added 12,000 jobs, which isn't much. The last 12 months, the average was 194,000. So that's just basically a blip. It's statistically no change. But there were numbers within that maybe say a little bit more about how the economy is doing. And basically the economy is doing pretty much as we say every week. It's doing pretty well, but there are signs of it slowing down, which is what we would expect if the Fed had raised interest rates for a couple of years, and the Fed started dropping rates again in acknowledgement that the economy has been slowing.
And some encouraging news on wage growth potentially in that payroll number, maybe a bigger gain for workers than we've seen in a bit, and especially when you consider a time in which, the inflation rate has come down. It's it's up and down here and there, but to grow wages at 4%, while at the same time we're seeing PCE now below 3, I think is a pretty important indicator of, okay, we're seeing some more bargaining power with the worker, but also some more buying power that comes from that.
I'm going to lob this over to Adam.
Because you see me chomping at the bit.
I know he likes talking about the fact that wages are growing faster than inflation.
17 consecutive months where wages have been rising faster than inflation. I know I say this all the time, and it's still my number 2 favorite thing to see all time. But it points towards a still healthy and steady consumer. And the reason why we focus so much on the consumer and that wages are outpacing inflation because it points directly to consumer spending. And that, as I said before, drives 70% of our economy. And if we are going to have any recession, it would require a collapse of the consumer. And at the moment, we're not seeing that.
A couple of numbers that I wanted to tease out of the jobs report that I didn't read a lot about. One is the temporary help number, which I always sort of see as a harbinger of hiring trends. That number is now, if you set aside the pandemic, that number is now the lowest it's been in almost 11 years. So that's been going down. It's down more than 500,000, more than 18%. Since it peaked in March of 2022. So that's something to keep watching. What was my other number that I was looking at? Oh, the other number was that, every month, John and I were talking about this before, the Bureau of Labor Statistics corrects the numbers. They have more data to work with, so they go back and the 2 previous months, they'll say, what numbers do we know better now that we can correct? And in the last 2 months, in August and September, there were 112,000 fewer jobs in the country than they previously knew. So even aside from the noisy numbers from October, August and September were weaker for the labor market than what we thought. But it's still a strong labor market.
And I think that's the key, right, is that if the expectation is the economy is slowing because the Federal Reserve has kept rates restrictive, even as they cut, still on the tighter side of maybe what we would deem to be neutral, well, you would expect that you'd be seeing some weakness. We see it in the manufacturing sector as well. We have an ISM number this week that has continued to point to a manufacturing sector that maybe, unlike the rest of the economy, probably is in a prolonged period of contraction.
Yeah, that number, it measures, talks to supply management managers and asks them how their manufacturing businesses are doing, and that number has been showing contraction 23 times out of the last 24 months. That's a pretty profound trend. At the same time, they do a correlation between what that number has been historically and how it tracks with the general economy, and based on that correlation, they see gross domestic product growing at 1.1% on an annual basis, and that's saying that the economy is still growing.
And I think we have a number from third quarter now, the preliminary estimate for gross domestic product, really big picture look at the economy, and a little slower than it was, but still some pretty meaningful growth here in the U.S.
And that's a very strong correlation to GDP, is the GDP number itself. So
that's how that works.
Yes, yeah. And that was 2.8% for the third quarter, which is down from 3% in the second quarter. But it's still pretty strong, especially when you consider all that those increased interest rates have done to try to slow the economy.
I think I have said this just about every week, it feels like, but there are just so many indicators out there. There's so many places you can point to go, hey, the economy looks great or the economy looks bad. And I think GDP is one of those I look at and go, okay, well, how do we summarize what's actually going on here? Certainly going to be some revisions. Certainly there's plenty of nuance. But if all we do is look at high level, is the economy doing okay? I think 2.8 to me in the third quarter from the second quarter suggests that it's more than okay. It's not great. It's not the 3 it was, but it's definitely more than okay.
And can I just point this out? We haven't mentioned inflation yet. And that's something that we've talked about in past podcasts, and you talked about it at the annual seminar, is that there's been an inflection where the Fed is no longer worried about inflation as much as it's worried about labor. And we've been talking about the jobs report, but there was another report, actually 2 reports this week, and the Fed's favorite number for measuring inflation showed that it was 2.1% in September, which is the lowest it's been in 3.5 years, and it's almost right at what the Fed has targeted as their long-term goal for inflation.
I think definitely still too early to say the Fed's won, definitely still too early to predict that there isn't something else out there, but I continue to be amazed at how well the Fed has navigated this. I continue to be impressed with how strong the economy has remained despite what was initially really high inflation, followed by a Federal Reserve that wasn't afraid to say, hey, we're going to do what we need to do to get it under control. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.